Good afternoon, everyone. A very warm welcome to all the participants joining us today. Today's webinar is not merely about refunds. It is not merely about IceGate, and it is certainly not merely about compliance. Today's discussion is about something much larger. It is about how Indian businesses respond when global events disrupt global trade. It is about how exporters preserve competitiveness when uncertainty becomes the new normal. And it is also about how professionals can become strategic advisors during challenging times. The theme of our today's webinar is export promotion measures and IceGate refund mechanisms for exporters in Gulf crisis. There is a remarkable quote by former Prime Minister Shri Atal Bihari Vajpayee. You can change friends, but not neighbors. The Gulf region has always been one of India's most important economic neighbors. For decades, it has been a critical trade corridor for Indian exporters. Therefore, whenever uncertainty emerges in that region, its impacts are felt not only on ships and cargo, but also on cash flows, logistics, working capital, and business confidence. And that is why today's discussion becomes extremely relevant. As professionals, we are no longer expected merely to interpret laws. We are expected to interpret change, to anticipate risks, and to help businesses navigate uncertainty. Dr. APJ Abdul Kalam beautifully said, we should not give up and we should not allow the problem to defeat us. Today's session is dedicated to exactly that spirit. I am CS Sapna Dilip Lunawat and I am delighted to be your moderator for this session. We are delighted to have participants joining from across the country. Also, we are privileged to have the two outstanding experts who will guide us on the topic, CA Rachita Bhargav and CA Manas Chug, with us today, who bring deep practical experience in exports, international trade regulations, DGFT, customs, FEMA, and cross-border transactions. Before we proceed, let me inform all the participants that you may keep posting your queries in the question box. We will try to cover as many practical aspects as possible during the session. So let us begin with this insightful journey together. To commence today's session, it is my privilege to invite a respected leader of a profession. A true leader not only guides institutions, he guides professionals towards preparedness and excellence. With great respect, I invite CA Rajendra Kumar P, the Vice Chairman of GST and Indirect Taxes Committee of ICI, to deliver the opening remarks. Sir has consistently contributed towards strengthening knowledge and awareness among members and professionals. We look forward to your valuable guidance. The platform is yours, sir.
Thank you, CA Sapna Lunawat. Very esteemed chairman and our dynamic leader, CA Umesh Sharma ji, our wonderful speaker, CA Rachita Bhargava, and in absentia and who is going to join very soon, CA Manas Chuk, and other staff of the GST Indirect Taxes Committee and the technical support people. Your committee on a weekly basis conducts programs and brings to you innovative topics on indirect taxation. Our chairman, CA Umesh Sharma, a visionary leader, an expert par excellence, and a deep thinker on GST, is a person who meticulously guides the committee and its activities. In fact, I must tell you, friends, his passion, his dedication is limitless. And I only wish that he achieves Himalayan heights in the profession. Today, the topic is very unique. I mean, everyone practices indirect taxes today, especially GST. GST is one portion of indirect taxes, not indirect tax fully per se. And practicing indirect taxes on various fronts. but there are certain niche areas, certain key areas. One such area is what is going to be discussed today. And we have experts who are going to speak on this topic. In these times when the world economy is going up and down, it is flexible taxes like indirect taxes which keep the governments going, which keep the country going. We are here to discuss today the refund mechanism with specific light to what is happening in our neighbors, the Gulf. India cannot be independent of its neighbors, let me tell you. We can never be independent of its neighbors unless and until we have our own crude, which we don't. We cannot. We are dependent on others, our neighbors, etc. And no country for that matter can be fully self-sustaining. No country can be for that matter totally free from outside influence, whether it is economic or socio-economic, whatever it may be. So these topics like this, which we are going to hear from the experts today, expand our horizon of knowledge that we possess. The knowledge of indirect taxes is limitless, sky high, I must say, or the width and the length of the sky, which can never be measured. It is like that. And we in the committee, under the chairmanship and leadership of our chairman, we explore and bring to you these topics. See, we may not have practice of the topic that we may bring at times in indirectly in GST. It may not be our area of practice also, it may be, but then there are learning experiences. And these learning experiences culminate into what will be practiced tomorrow. No learning goes waste. Let me tell you like this, friends. So thank you, Chairman, for bringing two wonderful speakers, especially Manas Chugh, whom I know him very well. He'll be joining very soon. A person who practices the law which is going to speak today. A person who knows the subject. And also son of a subject expert, C. Hansraj Chugh, the Central Council member. Okay. So friends, these are my opening remarks, and as usual, I'm eager to join you all in this fountain of knowledge that's going to overflow very soon. Rashita ji, welcome to you to the committee, and we are glad that you will be opening with your discussion today, and we'll be very happy to listen to you also, and to the ever-smiling Sapna Lonawat. I have seen her more than once in the committee, and thank you very much for, and keep this youthful exuberance with you, and always wear this smile at all times in life. Life always teaches us many things. Thank you. But then wearing this smile is something very important, and this will take you to places. Thank you very much. Over to you.
Thank you, sir. Thank you so much, sir. Thank you so much for your inspiring, motivating words. Sir, this really sets a tone for today's session, sir. Really. So, yes, coming forward, it gives me immense pleasure to invite the most respected voices in taxation, education, and professional development, the chairman of GST and Indirect Taxes Committee of ICI, CA Umesh Sharma. Under Sir's leadership, the committee has continuously organized initiatives like these and has helped professionals remain updated, informed, and future ready. Sir is the author of popular Karniti series inspired by Lord Krishna and Arjun, and is widely known for explaining complex tax laws in a simple and practical way. Because of his words of wisdom and guidance, many professionals fondly call him the Sri Krishna of our profession. With great respect, I request you, sir, C. Umesh Sharma, sir, the chairman of GST and Indirect Taxes Committee, to kindly deliver the welcome address. I request you, sir, to kindly address the participants.
Yeah, thank you. Participants, Sapna is known to me, so she speak somewhat extra about me. I am not the Krishna, I am still Arjuna of GST, and we are still learning. and knowledge never ends. We have to continue the journey of knowledge. And in that process, I have my guru today, RK sir, who is sitting there and guiding all of us. And under his passionate chairmanship, I never call him vice chairman because he is a passionate chairman of our committee. We are working hand to hand with the current changes that are happening in our economy. Friends, GST and IDT committee always try to bring you the latest topics, and this topic is the export promotion measures, because from last 6 months we are seeing that the domestic demand and the international demand and how to balance it, and how our suppliers, how our citizens of India will do the business in the changing scenario. And also the another part of the topic is ICEGATE major refund mechanism for exporters. So these are the two things that we are going to deliberate, and we are fortunate we have Rachita Bhargava and Manas Chuk who will be deliberating. So we have two eminent faculties today. Along with that, friends, we have our WhatsApp channel. We have regular this weekly series of webinar. Further, we are going to organize GST art sessions across India, near about 13 plus uh, batches are already been done. This is for adjudication representation in tribunal. We are also having outreach programs of GSG stat members across India. So please stay connected with GST and IDT committee initiatives through the WhatsApp channel, through the WhatsApp group, through the website of GST and IDT committee. And as guided by our President Prasanna sir and Vice President Mangesh Kendre sir, and also the continuous guidance of RK sir, we are bringing new initiatives for all of you. 14 books are already in process of publishing. These are relating to the sector specific GST books. So within 1 month, or say around 16th or 17th of July, when we are going to have our committee meeting at RK sir's home city, Chennai. We will be coming out of the some uh, one or two publications soon, and then on monthly basis we will be coming out of the other publications. We are very eager to have your suggestions, because your suggestions and your comment become part of our ICI representation, where CAG, where the Ministry of Finance, where CPIC called whenever they need the help for betterment of GST. And we all are proud that due to continuous efforts of RK sir and our team, we are the front runner in GST initiatives or GST reforms whenever government wants. So ICI is a proud partner in nation building, and in GST we are in front runner for contributing that. So friends, please stay connected, please stay updated, and happy learning to all of you. Thank you all of you for joining virtually, and over to you, Sapna.
Thank you, sir. Thank you very much, sir, for your warm and encouraging words. Sir, these publications, I'm sure these would definitely prove a knowledge addition to in practice to our members and even to the students and even to the whole fraternity, all commerce, all commercial fraternities, and even the people in the industry, sir. So that's an amazing initiative, sir. Um, yes. So, before we begin the discussion, let me ask everyone a simple question. When an exporter looks at the current Gulf situation, what is the biggest concern? Is it logistics? Is it shipping cost? Is it delayed refunds? Or is it a working capital or any uncertainty itself? Because uncertainty is often the most expensive cost in business. And that is precisely why conversations like today's are so important. To decode these issues, we have with us two highly experienced experts. And I would like to introduce our first speaker today, CA Rachita Bhargav, who are going to guide us on this. Just introducing ma'am. CA Rachita Bhargav is a practicing chartered accountant who has built a strong niche in export documentation, DGFT compliances, and international trade regulations. She actively advises exporters on foreign trade policy procedures, incentives, EPCG, advance authorization, and a wide spectrum of DGFT related compliances. What makes her work particularly valuable is her ability to bridge the gap between regulatory requirements and business realities. She works closely with exporters and manufacturers to simplify trade processes, manage customs compliances, and facilitate smooth international transactions. In a world where one documentation error can hold up an entire shipment, professionals like her become indispensable partners in international trade. Ma'am, we are delighted to have you with us today. I would like to call upon C. Rachita ma'am to address the participants with her knowledge and experience. Over to you, ma'am. The stage is yours.
Thank, Thank you so much, Sapna ma'am. That was really a warm welcome. And I would like to say a very good afternoon to the esteemed Chairman, sir, Vice Chairman, sir, and all the distinguished members of the Institute. I feel truly honored and privileged to be given this platform. I feel a great opportunity to present here before such learned and accomplished audience. RK sir and Umesh sir, we are always so delighted to hear from you and the works that they have done. And it's truly an honor to be presenting before them. So I'm CA Rachita Bhargav, a practicing chartered accountant specializing in indirect taxation and international trade. Over the course of my practice, I've had the opportunity to advise exporters, manufacturers, and trading houses on GST compliance, custom procedures, and foreign trade policies. Since time is an essence, given the ground of depth that we need to cover today, I'll move directly to the substance of our discussion. And I'll try my best to keep my conversation practical, to the point, and something that you can carry away to your clients, friends, and associates. So, firstly, before we get into the laws and the details, it is very important to have a glimpse on the situation itself. Because unless we understand what the situation is, what this Gulf crisis is, all the circulars or the schemes followed will make no relevance. So, first we have to understand what this Gulf crisis is. Now, the Strait of Hormuz is a narrow waterway which is connecting the Persian Gulf with the Arabian Sea. It is approximately a 25 kilometers of ocean in the world, and for India, specifically 52% of the crude oil imports transits this route. So, energy has definitely, as briefed by RK sir, that since we do not have crude of our own, we are certainly dependent on the imports of the crude oil. And so, energy is definitely an important part of the story. Now, the Gulf Cooperation Council, Saudi Arabia, UAE, Kuwait, Qatar, Bahrain, and Oman, is India's single largest trading partner. Every exporter in this room or every exporter around, whether they're exporting textiles, engineering goods, pharmaceuticals, or food products, a significant portion of their market sits on the other sides of the Strait of Hormuz. So, any disruption on the Strait of Hormuz is a direct attack or an effect to us. So, what happened in the end of February 2026? This geopolitical situation in the West Asia, it escalated sharply and affected the exports or the business or the trading through the Gulf of Hormuz, Strait of Hormuz. Now, it came under severe disruption. What happened? It was an absolute chaotic situation. The vessels were mid voyage, they were returned back. The ships were rerouted around the Cape of Good Hope, adding weeks of transit times and lakhs of rupees in additional freight costs. The cargo was offloaded at intermediary ports like Dubai, Colombo, Singapore, and the shipping lines, which could not proceed any further, they had to transship the goods. Now, emergency surcharges appeared overnight on the freight invoices. The marine insurance premium spiked. And due to all of this, what exactly happened? We'll have to understand what actually happened. The lesser the exports. The moment the exports are affected, it's going to have a direct impact on the rupee scenario. The lesser the inflows of dollars, the lesser will be the value of INR. And so it instantly gives a pressure everywhere. So, and to the MSME exporters who work with such thin margin and tight working capital, they found themselves in blocked funds. They had no clarity on the timelines. They had no clarity on the compliance. They had no clarity of their goods. There was the severe issue, but there was the serious issue. The exporters were all chaotic. They did not know what was going to happen next. But to credit this, the government had to act fast and had to move quickly. They formed an inter-ministerial group on 2nd of March to combine together the Ministry of Commerce, the Ministry of Petroleum, Ports and Shipping, RBI, and CBIC. All of them, they combined together to give they had to issue guidelines, they had to give out circulars, and they gave 6 very important circulars as per the section of 143 AA of the Customs Act. Now, these circulars were a great help. They were basically the directives as to how the goods were to be treated, how the goods should be handled once they were exported, and after this Gulf War started. So, we'll have a quick review of what these circulars were. The first circular that was floated on 8th of March, it simplified the return procedure. Now, what happened? That once the goods were exported and the goods were already in transit, and then this war situation happened, the goods were midway the voyage. They had to come back. But now we know that once the shipping bill is filed, once the let export order is confirmed, and once the EGM is filed, the Export General Manifest is done, we consider the goods to be exported. Now, once those exported goods had to come back, it was a big challenge. Basically, such goods are considered to be for re-import. But we had to call those goods back, and this circular helped a great deal in that. It helped in simplifying the return procedure, to offload the goods without bill of entry. It helped in shipping bill cancellation, post EGM shipping bill cancellation via the ICE gates. For example, if a textile exporter has already exported the goods. Now, the vessel is somewhere stuck in mid-sea and it has to come back. It comes back to the port. Then it will be considered as a re-import, and so the entire procedure of filing of bill of entry and everything starts. But with this circular, the shipping bill got cancelled, no import duty was triggered, and the goods were considered to be back to town. Then it was followed with another circular on 10th of March that at the time of uh, any amendment or cancellation of the export documents, no additional fees would be charged. The next circular was followed on 17th of March, which helped in the back to town and transshipment procedures. That how, if the goods, once they've been exported, once they have left the warehouse, once they have the let export order has been charged against them, how can we call the goods back to the town? How can they be brought back to the warehouses? The next custom notification helped us in the transshipment via third country ports. For example, the goods were already dispatched from the Indian port. Now, midway, they were not able to proceed any further. So, the shipping lines, what they did was offloaded the goods at some intermediary ports. So when the goods were called back from there, then they again had to be considered under the back to town procedures, and it had to be brought back to the country. So all these custom notification, they immensely helped in movement of the goods. The goods which were exported, the shipping bills were filed, the EGMs were drawn, but even after that, the government played a great role here and they ensured the goods were returned back. We understand that these all the six CBIC circulars, they are active until the 30th of June, which gives precisely exporters this protection within this window. But it is very important that we work within this window and bring our goods back to the town. Now we have to. There are few points that we need to keep in mind. Firstly, once we are calling the goods back, we do not have to file the bill of entry. We have to apply for the shipping bills cancellation. We have to ensure that the seal is intact. The seal cannot be broken or tampered, because if the seal is tampered, 100% examination will be mandatory for the same. Seal integration certification has to be obtained from the customs. We have to obtain the back to town movement order. We have to check the IGST refund mechanism. We'll discuss about it in our next coming up scene. And then we'll have to file the fresh shipping bill on re-export. So now these are the procedures which uh, we had to look for the customs notifications which came into actions for the Gulf crisis. Now, we move on to our next and a very important mechanism, which is the ICEGATE and IGST refund mechanism. Now, what is what is an ICEGATE? We know that ICEGATE is a bridge between custom and the GST worlds. It is the Indian Custom EDI Gateway, is the national portal of CBIC. Now, this is basically a digital nerve center for all custom transactions in India. Every shipping bill, every bill of entry, every EGM, it passes through ICEGATE. For the export refunds, it is a critical bridge between the customs and the GST world. Now, when an exporter ships good with the payment of IGST, this is the most common route under the Rule 96 of CGST rules. They do not they do not file a separate refund application for this. Now, once you are already exporting the goods with the payment of GST, you do not have to specifically file a refund for the same. The refund is meant to happen automatically, but it only depends on how the two systems, the GST and the ICEGATE or the customs, how is the communication between these two systems. On one side, we have the GSTN, which is the GST networks. We know that the exporter declares all their goods on the GSTR1. You give all the information of the exports that you do on GSTR1, and then you make payment of tax in the GSTR3B. Whereas on the other side, on the ICE gate, you file your shipping bill. When you file your shipping bill, you declare everything on that shipping bill: your invoice number, your invoice details, everything, and also the GST amount. So as soon as your shipping bill is filed, the information is transferred from the GST to the custom through IceGate. If all the information that you have filled in is correct, it is valid, your refund is seamlessly proceeded. So what happens? We'll just walk through it in a very swift manner. As soon as we file the GSTR1, we declare the export invoice with the shipping bill number, date, and port code. The data will automatically flow through the ICE gate. The exporter pays IGST in 3B. The shipping bill is filed at customs. So, under Rule 96, this is a deemed application for refund. No separate form, no separate portal has to be logged in for the same. Now, after the vessel sale, the shipping line files the EGM, which is the Export General Manifest. Basically, Export General Manifest is our key point. I mean, when the EGM is filed, we know that the export is completed. So this legally confirms that the goods have left India. Now, IceGate will cross-check all the data that it has received from the shipping bin and all the data that it has received from the GST department, from the GSTR1. It will match all the data and automatically process your refund. If there is any mismatch in the data which has been mentioned in the shipping bin, or which has been mentioned in your GSTR return, your refund will definitely get stuck. There are several error codes. We'll just have a brief look at the error codes in our next slide, where the which causes the stucking of our returns, of our refunds. The first is uh, SB 0001. Now, if there is any wrong number in GSTR1, if the EGM is not filed, if there is a mismatch in the invoice value, IGST is not paid, invoice number mismatch, if there is any kind of mismatch, then definitely your refund will be stuck. There will be issues in processing of your refunds. Now, what happened? Now, if we come to the Hormuz problem, this was a special problem. It was a crisis within the system. Now, in this situation, what happened? When the goods were already exported, as we said, in many cases, the EGM was already filed. And if the exporter has already filed their GST return, their refunds were already processed, and the refunds were processed, but the goods were not actually or really exported. The goods were stuck somewhere in between. And there were times when the goods had to be brought back. So now this is a problem. This is a situation in the Hormuz disruption that created that this is something very important, that each one of us, each one of us who exports or who give guidance to these exporters, we need to understand. Now, in cases where the cargo was returned, the EGM was already filed, and as far as the ice gate was concerned, the goods were left India. The ice gate has no intimation that the goods were returned back. The IGST refund was already in process, and in many cases, it was credited to the exporter's account. Now, this is an unresolved issue. The cancelling of the shipping bill on IceGate, it does not automatically reverses the IGST refund on GST and portals. Since these two systems are not integrated for the reverse flow, if the shipping bill was cancelled in the customs system, the GST will have no automatic knowledge of it. The GST refund, which is already credited, remains in the exporter's account, and the field informations have directed to recover it. So now, what as a practitioner or as the exporters, we need to understand that any refund that has not been correctly credited to our account, that has been credited to an export which was not actually made. Currently, there is no mechanism to get the refund or an automatic refund of the same, but this amount will definitely be recovered from you. So, it is always advisable. We should advise our clients or the exporters that they need to intimate the department about the refund which has been credited to them, and it is important that they make an intimation to it, because once the recovery will be there, the amount will be recovered along with the interest. So if you yourself proceed with the recovery thing, then maybe there will be no interest or penalty issues, and which is very much advisable, that the GST amount which has been received for the situations or for the exports which have not been made, they should be refunded back to the government, or at least notified, because they'll then decide how to proceed with the same. The same is the case with the raw debt and the drawbacks which has been received for the exports which were not made. There is no yet certain mechanism which can derive as to how these uh, uh, drawback claims or which were received for the exports which have not been made, how they're going to recover it, but they definitely will be recovered. So it is always advisable to pre-intimate as to this was the reason they have claimed it. And so this was all about the IceGate refund, the refunds through IceGate. Definitely, there have been cases where the refunds are stuck because the exports could not be completed. Since the exports were not completed, the exporters, they have blocked their funds. To ensure that this blocking of funds does not affect the exporters that badly, government has come up with another very good scheme, which is the interest subvention scheme. So now this interest subvention scheme is awarded to the MSME exporter clients. The scheme has come into effect from 2nd of January 2026. Now, now we have to think about a situation in which a cargo has returned for an MSME exporters. As we discussed, the MSME exporters already work with a very thin margin and tight capital fund situation. Now, these goods, which were supposed to generate dollar receipts in 60 to 90 days, they're now sitting in their warehouses. The working capital loan, finance production, and shipment is running. The interest is accruing. See, bank doesn't care if there was a war or what was the situation, but then the government does care. The government did think as to what has to be done in a situation like this when the EMI is still due. In this scenario, the government introduced this interest subvention scheme in which there is a reduction of 2.7%, 2.75% reduction in the interest cost on export credit, and this is not a minor benefit. For example, if you have an MSME exporter who has 2 crores in export credit outstanding, so 5.5 lakhs is back in their profit in their pockets with this discounted interest subvention scheme. Now, this is a very popular and a very important scheme. This is applicable to all MSME exporters. The MSME exporters who are Udyam registers, definitely, since they are MSME, they'll be Udyam registered. The scheme is for both the pre-shipment and post-shipment export credit. The rate of subvention is 2.75 per annum. It has an annual cap of 50 lakh per exporter. So per IEC, per exporter, you will be awarded with 50 lakh of interest subvention in the whole year. And this scheme has come into effect from 2nd of January. Now, the most now when this scheme came into action, for a very long period people were not aware. I mean, they all thought that this is going to be automatically credited to their bank accounts, which was not the case. For the scheme to be active and effective, a unique identification number was to be generated from the DJFT portal. So, what mostly exporters made the mistake, they did not generate the UIN number. So, and since we could see that the banks were not giving the benefit of this subvention, there was a clarification on 13th of May, which clearly stated that the scheme is eligible from 2nd of January, but if and for to avail the benefit of the scheme before the loan is credited to your account, it is important that you generate the UIN number. And unless the UIN number is generated, any loan disbursed before the generation of UIN number will not be eligible for the benefit. This caused a wave of tension in all the exporters because people were not aware of the UIN generation. So on 13th of May, DGFT issued a clarification and they benefited the exporters, saying that till 31st of May, that time has certainly passed already, till 31st of May, they were allowed to generate a UIN for the exports or for the export credit which was made from the period of 2nd January till 31st of May. So in that period, you could generate the UIN and could get the benefit from for any loan that has been generated or disbursed to your account after 2nd of January. So now, since that period is over now, any loan that now will be disbursed to an exporter, it is important that they generate the UIN number on the DGFT portal, provide that UIN number to your bank, on basis of which the loan will be credited to your account. So, what are the eligibility criteria or important things that must be met? Firstly, it is important that you have an active IEC. Your IEC should not be suspended or should not be in the denied entry list or DEL, as we all know. Secondly, you need to have a valid Udyam registration. Your Udyam registration must be current, annually updated. Any lapsed registration, if the registration is no longer valid, there will not be any benefit given to us for the interest subvention. Thirdly, your product should be in DGFT positive HSN list. Any restricted product will not be benefited for this interest subvention. So it is important that your HSN is in the positive list of DGFT portal. And fourthly, the UIN generated on the DGFT portal before the loan disbursement. This is the most critical and most commonly missed up. There is no exceptions now. I mean, there was a benefit till 31st of May, but then now there is no exception to it. If your UDIN is not generated before the loan is disbursed, you will not be benefited for the uh, uh, for this interest subvention scheme. Now, this unique identification number, it links the specific credit facility to the scheme. This unique identification number is linked to your IEC. So each IEC will have one unique identification number for the entire year. This UIN has a validity of 1 year. Suppose I generate a UIN today on 9th of June. Now this UIN will be valid till 31st of March 2027. So, in order to claim or avail the benefit of interest subvention beyond 31st of March, it is important that before that I apply for a fresh UIN. Now, and once the unique number is generated, it cannot be reversed. I cannot, there is no way to cancel it, or there is no way to get a prior UDIN number. As I already discussed, there was a relaxation under the Trade Notice 3 of 2026-27 issued on 13th May. And exporters who missed the UIN generation for credit availed between 2nd January and 31st May, they could generate the UIN retroactively before 31st of May, but now that window has been closed. So, henceforth, it is very important that we suggest our clients, if they are going after an export credit for the pre or the post export credit, it is very important that we generate this UDIN number. Now, secondly, so now there is another scheme which has been benefited or released, which my co-speaker, Mr. Manas, will be sharing in his slide. I'll just give a brief view about that. Is the relief scheme. Now, as we know that during the this crisis, the most affected was the exports in terms of the transit. So once they were already shipped, there was a huge freight cost on them. The goods were coming back, or probably they were not sure if they'll be receiving payment for those goods. For this, government has advised ECGC to be the window, or to be the facilitator to give us the benefit of the relief scheme. The relief scheme is the scheme in which all the increased or the emergency surcharge which has been charged on the shipment cost, there can be a huge relief given to the exporters for that. And also, the ECGC has enhanced its covers to ensure that all the exporters, if they already had the cover, they've tried to increase their covers to the maximum possible extent so that they are benefited. Um, Now, the relief scheme, disbursement, the ECGC claims, the drawback reversals, every single of these, they require a paper trail. It is very important that we pay very attention, a lot of attention on the documentation, because if we want to file the benefit, for example, if you want to file the benefit of relief scheme, it is very important that we have all the paper trailing, all the rerouting cost, every incremental freight value, every port handling charge, seal verification. Only then will we be able to apply for these benefits. So here I will just conclude that whatever we have discussed today, we've discussed on how customs issued several circulars in in lieu of ease of exports in the situation where the cargoes were stuck, where the cargoes could not move ahead, they were to be brought back, how they are to be handled, what compliances has to be taken for them, what paperwork do we need to do, how can we proceed with the IGST refunds, the drawback received, if the shipping bill was cancelled, how do we handle the GST refunds, and how do we have to advise proactively for the reversal of this, how for every MSME exporter, how important it is to help them in the scenario in where there is a huge capital blockage. How can they benefit from the government's subvention scheme? uh, how it is very much important that we ensure and maintain that there is a documentation trail. There's a paper trail of everything, all the freight invoices, everything, so that the matter can be reconstructed well whenever there is a need. So I would like to conclude my session now, and I will definitely entertain any questions that arise. And I thank you for the opportunity which has been awarded to me today. Sapna ma'am, you can please take over from here. Thank you.
Yes. Thank you, ma'am. Thank you so much. That was really a very powerful and practical takeaway. I think many professionals attending here today would immediately relate to this issue. Thank you so much, ma'am. Queries, ma'am, we would take the queries after both the speakers complete so that we can take them at the end. We can take all the queries from all the participants. Now, let me introduce you all, dear participants, to our next distinguished speaker, CA Manas Chugh. CA Manas Chugh, sir, is a chartered accountant and an economics graduate from the University of Delhi. Sir is a recognized expert in the field of international trade, foreign investment, and economic laws. He advises businesses on a wide spectrum of laws governing international trade and investment, including FEMA, foreign trade policies, SEZ regulations, customs, GST, free trade agreements, anti dumping laws, and other allied economic legislations. Over the years, he has advised numerous multinational corporations on India, entry strategies, and regulatory compliance, while also assisting Indian businesses in structuring overseas expansions and cross border investments. His expertise in international trade has helped both Fortune 500 companies and leading Indian corporates maximize export linked benefits and navigate complex customs and trade regulations. He has represented clients before the authority for advance rulings, appeared in matters relating to anti dumping investigations before the DGTR, and has actively contributed to economic policy discussions through various think tanks and industry forums. A highly sought after speaker, he regularly addresses programs organized by ICI, export promotion councils, Chamber of Commerce, professional institutions, and trade associations across the country. He is also a prolific author who has contributed extensively through articles published in newspapers, professional journals, and industry magazines. Sir, with a unique blend of practical experience, policy perspective, and deep understanding of international trade, we are truly privileged to have you with us today. A very warm welcome to you, sir. I would like to request you, sir, to address the participants with your knowledge and experience.
Thank you so much, ma'am, for this elaborative introduction. Before starting the session, I would like to first thank the Committee for Indirect Taxes, who have given us the opportunity to elaborate on a very important topic. That is, because of this specific Gulf War, there are multiple set of challenges which are coming up from the angle of not only as the indirect tax but as a whole the economy. The economy has faced different kind of setbacks because our current account deficit is increasing. We are solely dependent on different kind of raw materials like crude oil, like gold, silver, all these precious stones, which we are with which India has a huge specific demand but don't have a supply. So all these specific challenges where the Indian government is facing different set of issues. So the government has given up and provided different kind of relief measures. So I would like to thank the committee who have given me the opportunity, Umesh ji as well as Adindra Kumar ji, who has given us the opportunity to elaborate on this specific topic. With this, I would like to start with the session. Sapna ji, if you can allow me to share the screen so that I can share the screen on the PPT, or if you can share the PPT on my behalf, whatever that is convenient.
Yes, sir. Yes, I can share the PPT.
Or if you may also allow me to share that, both the things works.
Yes, yes, yes.
So already that was discussed in the first half of the session elaboratively by ma'am was on the customs angle and the customs, the GST angle plus the intervention schemes, what the specific changes that have incurred and are notified by the government of India. Now my specific next 45 minutes coverage will be on two specific aspects. One will be on the DGFT related matters versus the changes or the announcements that the government has initiated or announced in the last 3 to 4 months, looking into the purview of the current geopolitical situation, plus a specific different scheme under the export promotion mission. There are multiple schemes which the government has announced under the export promotion mission. I'll try to give a brief background about each and every schemes under the export promotion mission so that you will have a brief idea about different schemes so that you can advise your clients accordingly. So first is a brief background around the policy, the current policy which the government has on the export and imports. So the entire framework of the import and exports have been divided into two major framework. One is on the revenue angle, that is the customs and GST. The other is on the regulatory angle, that is the policies which are regulating the entire import export. So that is majorly, first is the FTDRA Act, second is the FEMA Act. Other part of it is like BIS, WPC, different kind of product specific acts. So under the FTDRA Act, there is a specific policy called as Foreign Trade Policy 2023, which the government, earlier the policy was used to be for 5 years. Now the government has announced the policy without any specific timeline frame, which is Foreign Trade Policy 2023. Now if we go to the next slide. So under the policy, there are two specific part. One is the what that is the Foreign Trade Policy to 123. The other is the Handbook of Procedures. That is the procedure which governs or which gives the procedural angle to the entire policy. So under the Foreign Trade Policy, there are total 11 chapters. Majority, like it's starting with the legal framework, then general definitions and the provisions, then the district as export hub, then exemption schemes, then APC schemes. So there are different. The objective of the Foreign Trade Policy, if we talk about, is first to increase the exports, because objective the government in India wants that they want to have an increase in the exports, and I won't say reduction in the imports. They want to regulate the imports, because under the WTO regulations there are multiple set of obligations which the Indian government has to follow, and one of the obligations that they have to follow is that they cannot completely prohibit the import of a particular product. Reason being that they want the WTO, because the government has signed a WTO agreement in 1995. It clearly states that there should be a free flow of goods. If the free flow of goods is being allowed to us as an Indian to different countries, likewise Indian government also has an obligation that they have to also allow a free flow of specific goods when they are imported into India. So the ma'am, if you can go to the next slide. Next slide, please. Next. Yeah, another, yeah. So under the foreign trade policy, if I talk about on the general provisions, so the entire policy framework, the entire import and exports have been divided into three specific parts. First is the free category. Free category means that you can import and export into India and from India anywhere across without any specific permissions. So 99% of the products falls under the free category. Why I'm discussing it is because in the today's scenario, the general provision is very important. But I'll brief it out why it is important. So what is exactly the general provision? So the entire gambit of import and export is categorized into three specific parts. One was free. Free means that you can import and export without any permission from the government of India. Next is restricted. Restricted means that you can import and export, but only with the permission of government of India and the concerned ministry. That means you cannot import and export without taking the permission from the concerned ministry as well as the DGFT. So restriction means you can import but with the permission. Third is prohibited. Prohibited means there are certain set of products which are hardly 50-60 products which falls under prohibited category. Why the government puts a particular product under prohibited category? Because first it can be a natural, for example, national importance. For example, like onion, wheat, sugar, these are products which can have a huge impact if there is shortage in the India's inflationary numbers. So that is why the government can prohibit export of these specific products or import of these specific products, because they don't want to hamper the India's basic specific needs. So the entire products can fall under free, restricted, prohibited. There is another category called as STE, that is state traded enterprises. That means only PSU can import and export that specific product. So why I was discussing this specific topic, next slide please, because there are certain products like gems and jewelry, like for example gold, silver, platinum jewelry. Everyone might have heard about, like there were different kind of increase in the specific duty structure on the import of this gold and silver, raw the gold and silver like doors as well as jewelry. Reason was because the government wanted to restrict these kind of specific products. So the restriction can be by through two ways. One is on the revenue angle, that means by increasing the specific duty structure. Second is by putting the product under the restricted category. If a particular product falls under the restricted category, so there are multiple set of procedures that they have to follow. First is you have to apply to the DGFT. DGFT sends that application to the concerned ministry. If the concerned ministry finds the application fit, finds your company as a fit category to import, then they give the NOC. Then the DGFT has a specific set of committee called as EFC committee. EFC committee then decides your case, discuss your case, and decides finally whether to give you the approval to import that product into India or not. So because the government wanted to reduce the dependency on gold, silver, platinum, so that is why they have restricted the category, all these specific gem jewelry as well as the raw import into India. You have to take the permission from the DGFT. Only after that you can import that specific product. Likewise, in the case of exports also, they have made few exemption, made few product into the restricted category. One was wheat, one was sugar. All these category have been fall under the prohibited category. That means you cannot export these specific products. It is not under the restricted, it is under the prohibited category. Next slide, ma'am, please. So this was the general provision. another set of change, next slide please. So another set of change that has happened recently was on the realization of exports. Realization of exports, I believe everyone might have heard about or have studied during the if you have any client which are dealing into import export, is the realization. So earlier the realization time for the export was for 9 months. That means once you have exported, filing of the shipping bill, from the filing of the shipping bill, you have to realize your exports within the 9 months time frame. What happened? Because the government thought that there are different kind of geopolitical challenges coming up, so they changed that 9 months to 15 months. So that means all your export you had to realize within the 15 months time frame. But now, recently, that means on 5th of June itself, what they have done is they have now reduced from 15 months to again 9 months. So now, as on today, once you are exporting from India, the timeline remains the same, that is the 9 months. Between November to June, the timeline was increased for 15 months, but now on 5th of June itself, the government, the RBI has changed the timeline of realization to again 9 months, because the reason is clear. The government wants foreign exchange. Earlier, when the timeline was 15 months, obviously there are certain set of challenges. The challenges was there was a late realization. So now what they have again reduced it to 9 months, because the government wants foreign exchange. Their foreign exchange is depleting. The country's foreign exchange is depleting. They have to sell the foreign exchange to maintain the rupee at a stage which is currently 95 also, near about 95, 94, 95. So they have to maintain by selling the foreign exchange. So that is why what they are doing is they are reduce the time frame of exports to again 9 months. Next slide please. So okay, so ma'am Meenakshi ji has allowed me to share the screen, so ma'am, I'll directly share the screen so it will be easy. So now the discussion I'll be elaborating is on the foreign trade policy. So foreign trade policy, why we are discussing it is because foreign trade policy, there are certain set of changes which the government has announced under the foreign trade policy. I'll brief it on the changes which have been made. Before that, I'll brief you about the schemes which are there under the foreign trade policy, so that you are aware of the scheme and the changes which the recent developments which are there under the foreign trade policy. So entire foreign trade policy benefits, they have specifically bifurcated into two parts. One is pre-export, the other is post-exports. Pre-export means before undertaking the exports, government are giving you different kind of benefits. Post-exports means once your exports is done, after that, after your export is done, then the government is giving you certain kind of benefits. So under the pre-export benefits, there are two set of benefits. One is advance authorization, the other is EPCG benefit. Post-export, there are four set of benefits. One is road tax scheme, SCS scheme, which was earlier there, now it is not there. Now other is DFIA, that is duty free import authorization. Next is post export EPC scheme. So pre-export means before undertaking the exports you are taking the benefit. Post exports means after doing the exports you are availing the benefit. So first we will be understanding on the post export benefit, that is the road tax scheme benefit. So what is the road tax scheme benefits? I'll brief you in the next 5 minutes on the benefit, then the changes which the government has announced under the recent 2 to 3 months, looking into the geopolitical environment. So road tax scheme benefit, the benefit is clear. It is basically remission of duties or taxes on export product. That means the government is remitting in the of all the duties or taxes which is being undertaken, or which has been you have paid during the manufacturing, which and ultimately the product has been exported. So how this benefit is being given? The benefit is given not in the form of individual company. They have to give a figure that for us the duty or taxes that you have to remit is this much amount. It is not the case. The government has come up with a specific industry-wise HSN code standardized rate. That means there is a specific appendix, that is appendix 4R, which prescribes that under the appendix 4R you have to see the HSN code of the product, the 8-digit HSN code of your product. Once you see the HSN code, you will be able to see the exact road tax benefit which is available to you. So it is industry wise same. So the road tax scheme benefit has been prescribed, and the benefit is ranges from 0.5% to 4.3%. Maximum benefit is majorly around 1.5 to 2%. 4.3% is only for selected items, which, for example, items which are of agriculture, food processing. Otherwise, it is generally 1.5 to 2%. So 1.5 to 2% of what? It is 1.5 to 2% of the FOB value of the export. It is not the CIF value. It is the FOB value of your exports. The government is giving you a direct benefit. Next, the benefit is directly given to you as a cash benefit, or it is in the form of a certain kind of different script or something. So under the roadmap scheme, it is not a benefit which you will get directly to your bank account. It is a script. It is in the form of a script. So it is not a paper that you will be getting. It is not something that a paper, a physical paper that you will get it from DGFT or custom. It is an electronically generated script in the form of a ledger. So that ledger you have to generate on the ICEGATE portal. I will not go much into detail on the procedural angle. If someone has any specific question on the procedural angle also, you can just write to us, write in the question Q&A. I will try to, if the time permits, I will try to clear your answer question at the end of the session. So it is basically not a direct cash benefit. You will be generating a script. That script, you can use it for payment of a basic custom duty. It is not that the script is generated and that amount is being credited to your bank account. It is not the case. It is a script which you can utilize for making the payment of a basic custom duty. That means if you are importing, you have to pay the basic custom duty. So rather than paying the basic custom duty directly through your cash, you can pay it through the electronic credit script, that is the roadmap script. So what if you don't want to import, you don't have any import, you can directly you just export. In that case, what happens? In that case, you can sell that script. It is a tradable script. So you can sell that script to another party, and that party can buy the script. They don't buy the script as it is. For example, 10 lakh script is issued, so they don't buy it as it is. They generally buy it at a discount. So for example, 95%, 96%, 97% basis the market rate, on the discount they purchase the script. So these are certain kind of ineligible categories in which you are not allowed to get the roadmap scheme. That is the deemed export category, minimum export price, re-export for import for re-export. That means as it is you have imported and then exported. So goods that have not been taken to use after the manufacturing. So there, if goods is being exported through the warehouse, that is the customer owned warehouse. So these are basically the ineligible categories of the roadmap script. So why we have discussed it today? Because there was a very important recent development under the roadmap script, that was the script rate that I've already explained it to you. It has been defined under the Appendix 4R. So Appendix 4R defines the script, the rate of benefit on the percentage of the FOB value. So earlier, the budget of the entire roadmap scheme was around 18,000 crores. But in the budget of 2026-27, they have entirely reduced the specific. They have entirely reduced the specific roadmap benefit from 18,000 to 10,000. So they have approximately 50% reduced the entire roadmap budget. So with that reduction in the roadmap budget, everyone was expecting that the percentage of the roadmap amount will also be reduced by half. So that was also seen in March month itself. The DGFT on a random day itself announced that the entire roadmap rate of that is mentioned in the Appendix 4R will be reduced for all the specific HSN codes by 50%. So later on, what happened? There were multiple representation by the stakeholders to the DGFT that how come you are reducing the rates. There are multiple set of challenges on the geopolitical fronts, and you are reducing the roadmap rate because it's a very big benefit which the government is giving to the exporters, and it is part of the profit also. So what they have done is they have revisited that specific circular, and they have come again with a revised circular notification which mentioned that the roadmap rate will be again increased to the normal what was earlier that was there. So Appendix 4R was earlier, the rate which was reduced to 50% has been gone away with. Now the current rate was still there, which was earlier there too. But what the government has currently this benefit has been given only till 30th September. So roadmap scheme benefit is only till 30th September. So rate and value caps is still the same, which was there under the Appendix 4R and 4RE. There's no change in the rate, but it is expected that once this whole geopolitical situation normalizes, after 30th September, there can be a reduction in the entire roadmap rate structure. Next is the Advanced Authorization Scheme and DFIA. So what exactly is Advanced Authorization Scheme? I'll just brief on the schemes and then the changes which the government has announced under the recent geopolitical situation. So what exactly is the scheme? That advance authorization scheme is basically, as under the advance authorization scheme, it is part of the foreign trade policy. The scheme provides that you can import the raw material duty free. That means you can import the raw material duty free, subject to the condition that you have to export the finished product. The condition is simple. If you are importing raw material for manufacturing of a finished product which is exported outside India, then in that case, you can import the raw material duty free. So that raw material can be imported duty free under the advance authorization scheme. So duty free means complete duty free. That means you don't have to pay the basic custom duty, social welfare surcharge, GST, anti-dumping, safeguard, countervailing, any kind of duty that is being levied by the government of India. You don't have to pay the custom duty. So this entire custom duty that will be exempted if you are importing under the advance authorization. The eligibility is simple, that you have to export the finished product using, for example, for manufacturing of the finished product which is exported, you can import the raw material duty free. Next condition is that there has to be a minimum value addition of 15%. That means a minimum value addition of 50% has to be there. That means, for example, if you're importing a raw material, for example, 100 rupees, the export value has to be minimum 115. It cannot be that you are exporting and your export value is only 110. Minimum value addition has to be at least 15%. And there is a time period condition. Time period condition means the date you have been given the benefit of advance authorization. Basically, a scheme, a duty, basically a license is being issued to you. On the date of the license, the validity of the license is for 12 months. That means once the license is generated to you, for example, as on today, it is generated on 9th of June. So the validity of the license will be 12 months from the date of issue of the license for the case of imports, and for the fulfillment of the export the timeline is for 18 months. So 18 months is not from the date of import, it is from the date of the license. So from the date of the license, 12 months is the timeline for importing, and 18 months is the timeline for exporting. So this is the time framework under which you have to complete the export obligation. So the entire procedural angle is you have to first take the advance authorization scheme benefit. You have to get a license issued by the DGFT, where you have to explain what you will be importing, what is the raw material, what is the exports, what will be your value addition, what is the import value, and everything you have to prescribe. Basis that, the DGFT will issue you a advance authorization under which you can start importing the raw materials. So once you have imported raw materials, manufacture the finished product, and you have exported, and your shipping bill, you have to mention the advance authorization scheme number and the date. Basis that, and also certain specific conditions which has been prescribed under the policy. I won't go much into detail on the procedural angle. So once your obligation is completed, you have to go back to the DGFT that you have completed the obligation. Then after they satisfy, the DGFT is satisfied, they issue your EODC, that is export obligation discharge certificate. The government has discharged the entire obligations that was imposed to you under the advance authorization. So what is the relaxation which the government has given? The benefit which the government has announced is they have on 6th of March, they have introduced a policy public notice in which they have mentioned that if your advance authorization obligation period was expiring between 1st of March 2026 till 31st of May 2026, then your export obligation means your export period will be stand automatically extended till 31st August. So if your export obligation period is expiring between 1st March till 31st May, then it will be automatically extended till 31st of August. So this is the relaxation which the government has announced under this geopolitical situation. Next is the EPCG scheme. EPCG scheme is basically, under the EPCG scheme, the government is allowing you to import capital goods duty free. So under this, you can import the capital goods duty free. If the government is giving you a benefit of duty free import of capital goods, the government will be expecting something from you. So what is the expectation? What is the obligation? The obligation is simple. The obligation is that whatever duty that you have saved when you are importing the capital goods, whatever duty that you have saved, six times of the duty that you have saved, you have to export in 6 years. So duty, for example, I've imported a raw material, imported a capital goods which valued 10 crores. On that, for example, on that, I have saved a duty of 1 crores. So what the government is saying, 1 into 6, that is 6 crores you have to export in 6 years. So if a company which is already undertaking exports, so for them there is another kind of set of obligation, that is the average obligation. So there are two obligations. One is average, the other is specific. Average means the past 3 years of average. So whatever that you were exporting already in the previous 3 years, average of that you have to continue exporting. In addition to it, 6 times whatever the duty that you have saved, 6 times of that you have to export. You have to export in 6 years. So there are two set of specific obligation. One is average, the other is specific. So both the scheme benefit, both the obligation has to be completed. Now the time frame has been defined. Time frame is 2 years. 2 years for the case of import. It means you can import within the 2 years time frame from the date you get the EPCG scheme benefit. But condition of 6 years, you have to complete the complete export obligation. Another condition is 50% of 6 years you have to complete in 4 years. Remaining you have to complete in 2 years. So minimum 50% you have to complete in 4 years. Remaining you have to complete in the next 2 years. So this is a set of export obligation that has been prescribed under the EPCG scheme. Next, because their government is giving you different kind of specific benefits or an incentive, but the condition, I won't go much into detail on the incentives, because I'll just directly go into the benefits which the government has recently announced, or the relaxation. The benefit or the relaxation that have been announced is, if your export obligation, that is if your 6 years is expiring between 1st of March till 31st of May, then the export obligation will stand automatically extended till 31st of October. So the government is saying that because it's a geopolitical situation, there can be your specific exports can be hampered. So the government is saying because the export is being hampered in, so your export obligations will stand automatically extended till 31st of August. So it is for both the case, your complete 6 years or 4 years. 4 years I've already explained. 4 years is that 50% you have to complete within the 4 years time frame. That is called as block extension, block wise export obligation. So if your 4 years is also expiring between these specific time frame, government is saying that your block also will stand extended till 31st of August. So both these specific benefit the government has come up with looking into the geopolitical situation, because there are certain set of challenges. There are multiple challenges on the cancellation of the export order. So that is why what the government has said, they are extending the export obligation period, but the government has not said that they will reduce the export obligation. The government is not saying that your 6 time will reduce to 5 times or 5.5 times or 4 times. The government is saying you have to still complete the entire 6 times, but your export obligation will stand extended. So this is the benefit which the government has announced on 6th of March, looking into the current geopolitical situation. So this was the benefit which the government has announced on the DGFT benefits, that is the advance authorization, EPCG and the road tab. Now I will cover on the export promotion mission. So I have 30 more minutes. So I'll cover on the export promotion mission benefits. That is the benefits which the government has come up with under the export promotion mission. Looking, I won't say the entire benefits have been covered only looking into the current geopolitical situations, but all these benefits that the government wanted, that because the MSME are facing different set of challenges on the infrastructure, different cost, not only just the labor but also on the inflation numbers. So the government wants that for the exporters there has to be certain kind of benefits. So that is why the government has come up a export promotion mission. So under the export promotion mission, the entire budget is around 25,000 crores for 6 years. It is not for 1 year, it is for 6 years. The government has come up, and this benefit is only for the MSMEs. It is not for all the companies which has crossed the MSME limit. Only for the MSMEs the export promotion mission benefit has been given. So entire export promotion mission benefit have been divided into two parts. One is Niryat Protsahan, another is Niryat Disha. So Protsahan are the financial enablers. Financial enablers means the government is giving you a benefit on the, in terms of the finance, in terms of reducing the interest or reducing different kind of financial obligations. Niryat Disha is on the non-financial enablers. They are giving you benefit not directly in terms of the financial angle, but on how you can increase your export numbers. So under the Niryat Protsahan, we'll be discussing few schemes, and then we'll be discussing on the Niryat Dasha. Under the Niryat Protsahan, the first scheme is the interest subvention, which ma'am has already discussed in detail on the interest subvention schemes. I won't much discuss. Next is the collateral support. The other is the alternate trade instruments, credit for e-commerce, then the emerging export opportunities. So these are basically the benefits which are there under the financial enablers, that is the Niryat Protsahan. Now we will be understanding the benefits which are there individually and in detail. So first is the collateral guarantee support. So as the name is suggesting, collateral guarantee support. So what does it mean? It means that government is giving you a certain kind of collateral. So collateral is being given not directly to you, but directly to the bank. So when, for example, an MSME exporter goes to the bank, and bank generally refuse if they feel that there are certain set of risk involved in your loan application, the bank generally refuse different kind of in these kind of cases. So what the government is saying, that the government will give you a credit guarantee. Government will give you a guarantee cover. It is around, for micro and small it is 85%, and for medium it is 65%. So what the government is saying, that so for example, if a small exporter takes a loan of 10 crores, so government is saying under this specific scheme, under this specific collateral, a guarantee, government will cover 85%, that is 8.5 crores. The government will be giving a collateral. So collateral will be given to the bank. Basis that collateral, the bank will also be willing to give you a loan. For the medium it is 65%, for the small and micro it is 85%. And there is a specific condition also how much the government will be giving a guarantee. So maximum guarantee limit is 10 crores per year. In addition to it, guarantee is only, the coverage is limited only to the export linked working capital credit. It is not a loan. It is not basically a loan which under which you will be given a guarantee. It is a working capital credit only under which the government will be giving a guarantee. Next will be, loan must be taken from a CGTMSC member bank. Exporter must file an intent similar to what you have understood in detail on the UIN when you have to generate when you're availing the benefit of the interest subvention. Similar to the interest subvention, when you're availing the benefit, you have to get a UIN generated before availing the loan facility. Likewise, in the case of credit guarantee also, you have to generate a UIN. Basis the once the UIN is generated, that UIN have to give it to the bank. Using that, the bank will be giving on the bank they will be giving you a loan, wherein the government will be giving you the guarantee cover. So these are basically the eligibility criteria. It is not for entire HSN codes. Only 4139 tariff lines have been notified, which are the eligible categories under which you can avail the specific guarantee cover. So the application has to be submitted to the DGFT portal. That is a Trade Connect portal. It is not on the dgft.gov.in. It is a Trade Connect portal which the government has specifically has announced for the export promotion mission, wherein you have to. So it is mandatory that you have to, before availing the loan, you have to specifically file an intent. Next is basically alternate trade instruments. So what exactly is alternate trade instruments? As the name is suggesting, it is basically, so once you are exporting, so there you have two specific types of ways through which you can avail the loan facility. One is basically pre and post shipment, you can avail the loan facility for the working capital from the bank. For that, you can first take a interest subvention under the interest subvention scheme. You can take the interest credit guarantee under the guarantee cover. Second is on the alternate trade instruments. So what exactly is alternate trade instruments? This means that once you have exported, government once you have exported, you have an option for export factoring. That means factoring means, you know, that your export invoice can be factored. That means you will be getting an immediate cash instead of waiting for the payment. That means for 6 months, 9 months, whatever the time frame that you have decided with the, like in terms of the commercial that you have decided with the company to whom you are exporting. So you can directly take an immediate cash. So there are multiple factoring in, companies. So if you can get from the factoring companies, you can get your export invoice factor. So generally it is 30 to 90 days is the credit time that you can enjoy as a working capital. So what the government is saying, that this is what the government is saying for the export factoring. If you are doing the export factoring from the institution which have been regularized and notified from them, for there will be an interest subvention. That means the MSME will get a 2.75% of interest subvention. Likewise, in the case of interest subvention scheme, where you are getting an interest subvention for working capital loan for pre and post, for this also, if you are getting your export invoice factored, 2.75% of your interest that you have to pay to the factoring company, 2.75% will be given as you as a, for example, interest as a subvention. So this is likewise for the interest subvention scheme. Here also the condition is same. It is first for 4139 specific line items, you have to get a UIN generated. UIN also generated from a Trade Connect portal. UIN basically is an intent to claim. It is not mandatory that once your UIN is generated, you have to take the benefit. It is basically an intent to claim before availing the factoring from the factoring in company. So this is a similar kind of benefit which you will can avail under the interest subvention scheme. Likewise, here only for the factoring that you are doing 2.75% as a interest subvention you can avail for the factoring charges. There is a specific cap of 50 lakh rupees per IC per year. Next is for the e-commerce exporters. So what is the benefit under the for the e-commerce exporters? For the e-commerce exporters, because these are specifically very small exporters, or the quantity or the value of the export is also very small. It is not a bulk as export. It is small kind of exports. So for them, generally e-commerce exporters are can be first time exporters also. So what the government is saying, for the e-commerce exporters, the government is giving a specific benefit of a guarantee cover. That likewise for the credit guarantee, here also the government is giving guarantee cover. So what is exactly guarantee cover? The government has divided the e-commerce into two parts. One is the direct e-commerce credit facility. For example, if I'm exporting through Amazon, so for example, I got an Amazon order directly through the Amazon, I've exported the product to the concerned buyer. Another part is, if for example, I'm not directly exporting to the concerned buyer, I'm keeping that specific goods, all my for example laptops, in the premise, that is the in the warehouse of the Amazon. Rather than directly selling it to the buyer, I'm keeping in the warehouse of the Amazon. So that is called the second part, that is the OICF, that is Overseas Inventory Credit Facility. So what the government is saying, if you're a direct e-commerce exporter, then in that case 90% of the credit guarantee will be covered by the government of India. If you are exporting through the inventory, that means you're putting the product in the inventory and then you are selling, then in that case 75% credit guarantee will be given. So 50 lakh is the cap for the DECF, that is the direct exports. Here the as there is a reduction, it is from 90%, they have reduced to 75%, because why they have reduced for the overseas facility, they have reduced the guarantee cover, because they feel that when your product is in the inventory, there can be a possibility that the product gets expired, the product is not sold, so it has to be returned back to the origin country, that is India. So what they are saying is they are giving you the guarantee cover. So government is saying not only is the guarantee, if you want to avail the interest subvention, you can avail the interest subvention simultaneously also. So both the benefits, interest subvention as well as the guarantee cover, you can avail if you are exporting through the e-commerce. Next is the emerging export opportunities. So what do you mean by emerging export opportunities? Under the emerging export opportunities benefit, if I give you a data, around 40 to 50% of our exports, around 50% of our exports are only to 5 specific countries, and 20% of exports, out of 50%, 20% of our exports is to US. So 20% of our exports are to US. Apart from it, it is Netherlands. So what the government felt that we are exporting only to selected countries. So after the US has announced different kind of tariffs, that is US tariff by the Trump, government is the government and the exporters are at a shock, because once the tariff is earlier it was 25, then 26, then it was 50%. Now it has been reduced to only 15% and 10%. This is the product. So the government felt that we as Indians are dependent on only few specific countries, only 45 countries, wherein 50% of our total exports are there. So what the government is saying that you should diversify the basket of your exports. So what the government is saying, that government has come up with a new specific scheme called as emerging export opportunities. So why this benefit? The benefit is there because government is saying if you are exporting to these specific countries, there can be a possibility that the export factoring companies or exim banks, they won't entertain, they won't give you a pre and or post specific interest loan, or basically factoring your specific invoice. So why the benefit? The benefit is because if you're exporting to these risky countries, government is saying if you're exporting to risky countries, then government will give you the guarantee cover. The government is saying that we will be sharing the potential loss. So if there is a potential loss, then the government will be giving a guarantee and will be giving the cover. So the coverage will be from 10 to 90%. They have defined the country wise, they have defined the risk. They are specifically countries which they have defined which are eligible under the emerging export opportunities. And the government is saying for each and every specific exports, like countries, the government has prescribed 10 to 90% basis the risk they feel they have when they are exporting to this country. For example, certain country which they think that which has a higher risk, the government is giving a higher cover. So once the government is giving a guarantee to it, the bank will be willing to give you a pre or post different kind of benefits in the form of a loan. So this is basically a benefit which is there under the emerging export opportunities. Next is basically the trace. So what exactly is trace? Trace means that your, just give me a second. So next benefit which we were discussing was trace. So what exactly is trace? Trace is basically part of the Niryat Disha. It is non-financial enablers. Till now, what we have discussed is basically financial enablers. Government is giving you in the form of a financial benefit like interest subvention benefit, credit guarantee, benefit for the e-commerce exporters. All these are benefits which the government, emerging exports. So all these are benefits which the government is giving you in the form of financial enablers, either in the form of interest subvention, either in the form of guarantee. So they are giving you a benefit in the form of financial enablers. Now next part will be understanding on the non-financial enablers. So non-financial enablers means that the government is giving you a benefit to give you certain kind of benefits, either in the form of a quality certificate reimbursement. If you are you are planning to set up a exhibition outside India, certain kind of benefits. So we will be discussing each and every benefits which are there under the non-financial enablers, that is Niryat Disha. So first is the trace. Trace is basically trade regulations, accreditations, and compliance enablement. So what do you mean by these kind of benefits? Under this benefit, there are certain set of quality challenges. Once I'm exporting, for example, I'm exporting to US, I'm exporting to European Union. The real set of challenge for the exporters in India is that that they are not able to fulfill the specific quality or safety standards which are being prescribed by that specific country. So there are specific certification, testings, or different set of challenges which are specifically announced. So what the government is saying under the trace, the government is saying what they have defined, they have defined certain kind of certificates. For example, I want to export to US, and the US buyer has prescribed that you have to get the ISO certificate. Without the ISO certificate, I won't be accepting your order. Or for example, you have to get the CE certificate, otherwise I won't be accepting the order. So these are certificates which is not cheap. It is basically, it is not affordable. You have to shed around 20 lakhs, 5 lakhs, 15, 20 lakhs. Only after that you have to comply with the audit of the specific certification also, then only you get the specific certificate. So what the government is saying under the trace, the government has prescribed certain set of goods, and also that is the eligibility goods. Here in the slide also you are able to see Annexure 7. Annexure 7 prescribes the eligible goods. There are certain goods which the government has prescribed, that is the eligible goods which have been given the benefit under the trace. Next is the eligible certificates. So government has also defined the certificates which are eligible. There's like for example ISO, CE. So there are certificates which the government has prescribed, and also prescribed how much we will be reimbursing when you are availing the when you are complying or when you are undertaking the specific certificate or the testing. So reimbursement is up to 60%. It is not fixed at 60%. For each and every certificate, their government has prescribed certificate wise how much you will be getting the specific benefit. So I'll repeat the benefit because it is a very important benefit. The benefit is simple, that once you are exporting from India, government, there are multiple set of testings, compliances, certifications that is required by the buyer who is sitting outside India, because you cannot import, for example, if you're you're exporting food products, so FDA specific regulations have to be prescribed it. So there are multiple set of compliances that you have to follow. So what the government is saying, if for the exports, if you have to get a specific testing, compliances or certificate done, then in that case government will be reimbursing up to 60% of the cost. So what you have to do next, if your product falls under that specific, you have to take the specific benefit. First, you have to see whether you are fall under the eligibility criteria. First is the goods. If your product falls under the eligible goods, yes, then in that case, second, you have to see whether the certificate is, they have also to prescribe the specific certificates. So if you're also under the positive list for both the, if you're fulfilling both, then you are eligible to take the benefit. So how you have to take the benefit? First, likewise in the all the schemes benefit, you have to file the intent to claim. Once your intent to claim is filed, then in the intent to claim, you have to mention which specific certificate you have to take, where you are exporting, and the details of the exports. Once your intent to claim is filed, you will be generating a unique identification number. After the unique identification number is generated, you have to proceed with the testing or the compliance. So once your testing is done, then in that case, you have to, once you get the certificate, it is not that without this getting the certificate, you will be given the reimbursement. So once you get the certificate, you are eligible to take the benefit as a reimbursement. It is not basically the amount will be reduced, it is in the form of reimbursement. So 60% of the cost on a tentative basis will be reimbursed to you. The annual cap is 25 lakh rupees per IC, and you can process the claim on quarterly basis. It is not for entire for the year you have to do it. You can do it on the quarterly basis. But a very important condition, once you get the certificate, only after that you are eligible to get the reimbursement. It is not like you have applied, you have made the fees, and then you apply directly to the DGFT to get the reimbursement. Once you get the certificate, after that you will be given the benefit of a reimbursement, because you have to upload the certificate also and the details of whatever the complete compliance you have done. Basis that only there will be a disbursement by the DGFT. Next is basically MAS, that is market access support. I won't go much into detail on the market access support because it is not directly linked with the exporters. It is basically for the international trade fair exhibitions. If, for example, the export promotion councils, the trade unions, not unions, basically the association, the trade associations, FICCI, CII, SHM, or different trade associations, if they are, for example, planning to like be part of a exhibition or trade fair, then the government is giving a benefit to the specific trade organizations, associations, under which they are giving different kind of reimbursement to the specific trade associations like Export Promotion Council, Commodity Boards, industry associations, trade bodies, government agencies. Only to them only they are giving the benefit. Indirectly, the benefit will be provided to the exporters, because these specific promotion council have to pass on this benefit to the participating entities like Indian exporters, but it is not directly a benefit which the Indian exporter can directly avail. Next is flow. So flow is basically logistics, overseas warehouse and fulfillment. This is also not directly linked to the exporters, but a very important benefit. So what exactly is the benefit under the flow? Under the flow, the benefit is simple. If, for example, the major set of challenge when you're exporting is that, for example, you're exporting to B2C, that means to directly consumers. So for consumers, you cannot, for each and every sale, you have to you can sell, you can directly export or ship, because that will be a huge burden on you on the logistic cost. So what you generally do is you put your product in the warehouse outside India, for example, Amazon warehouse outside India, and once you get the order directly from the product that you have in the warehouse, you directly ship it to the end customer. So what the government is saying is, government wants to encourage the overseas warehousing and storage area. Government wants that Indians also should have overseas warehouse directly. So Indian exporters can also have directly overseas warehousing and storage facility. So for them, what the government is saying, that if you have a fulfillment service center, customer support infrastructure, or overseas warehousing and storage facility, that if you are planning to have it, government will be giving you a 30% of the project cost as a benefit directly. So it can be directed to the councils, state bodies, or logistic firms. So these benefit is majorly for the logistic firms, not to the exporters, because only exporters doesn't have a warehousing facility directly. So their benefit has been given to the council, trade bodies, and logistic arms. So the benefit is 30% of the project cost. Project cost means whatever infrastructure cost which will be incurred in getting the specific logistic facility prepared. For 30% of the project cost will be reimbursed to you. So there's a maximum cap of 10 crores for warehousing, and 5 lakh per month for fulfillment, 5 lakh for display facility, 10 crores for the e-commerce hubs. This is the maximum cap, but 30% of the project cost and the annual ceiling which has been prescribed with. So it's a very big benefit, but the benefit will be accrued only to the companies who are planning to set up their own warehousing or logistic facility outside India. Next is lift. Lift is basically a freight and transport, a very important benefit, but the real challenge for the under the benefit is it is only for selected companies. That means for selected eligible products. So what is basically lift? That is logistic, freight, and transport. What the government is saying is for certain specific set of products. So for products which have been prescribed, I'll also mention on the products which have been prescribed. So I'll brief on the product itself. Let me tell you the product first. Products are walnuts, pineapples, lemon, kiwi fruit, lychee, makhana, saffron, mixed spices. They are prescribed under the Annexure 6, sorry. Under the Annexure, they are prescribed certain set of products which are eligible under the lift. So what is the benefit? The benefit is these products which the government has identified, they feel that the products logistic cost they have a huge logistic cost burden. Why? Because they are very far from the port. They are very far from the ICD, that is the container depot, or the main port. So the government felt that they should be given certain kind of reimbursement or subsidy on the logistic cost that they will be incurring. So what they are saying is a logistic shipment, the 20% of the freight will be the maximum 20% FOB, basically 20% of the freight cost, if we will be given you a reimbursement. And but the condition is, first the product has to be at least the product which has been manufactured. The manufacturing facility has to be at least 200 kilometers away from the ICD or the main port. So if your manufacturing facility is more than 200 kilometers away, then in that case 20% of the freight will be given you as a reimbursement. So it's a very big benefit. Another condition is, because it is only for the MSME, the condition is that maximum 20 lakhs will be given per IC per year. So two specific eligibility criteria. First, 200 kilometer cap. That means if your manufacturing facility is beyond 200 kilometers from the ICD or the port, then only you're eligible. Second, your products will fall under the eligibility products. So the eligibility products already I've explained, like walnuts, kiwi fruit, makhana, saffron. If you fall under the eligibility products, also with the kilometer criteria, then you're eligible to avail the benefit of the lift. So benefit is 20% of the freight cost. Another benefit is that 20 lakh will be the maximum cap. So this is the benefit which the government is giving you under the lift specific benefit. Next is insight. So insight is basically also not much relevant for the exporters, but benefit is basically capacity building. So government wants, because the major set of challenge for the exporter is that there are hardly any professionals or people who are involved in the export and import documentation and compliances. So what the government is saying, for the capacity building, for making sure that the knowledge skills has been given to the specific at large multiple people, so they're giving different kind of capacity building enabling benefits. So for example, trade for export promotion councils, if they organize if they organize, for example, certain kind of events, seminars for the benefit of the exporters, for understanding building the capacity building, then the government will be giving benefit to the companies who are organizing different kind of capacity building sessions. It is not like, for example, I organize a import and export capacity building session and I will be giving a benefit. They have a certain specific criteria. There has to be, the institute has to be certified or regulated by a certain specific regulatory authority, then only you will be eligible to avail the benefit. So implementing agencies can be through EPCs, government export bodies, DPCs, MEA missions, academic institutes. It is not like you or me can start this specific capacity building and can avail the benefit. So these are basically the entire export promotion scheme benefit. I know in the last 1 hour we have discussed a lot of the gambit of schemes, so there can be a confusion. So let me just concise it. The entire export promotion mission. First was the interest subvention scheme benefit. That was the benefit was 2.75% of the export, basically the interest subvention which will be given for pre or post export loan which you are taking. Next is the collateral. If you are taking a export working capital, it is only for working capital. If you're taking a working capital loan from the bank, then the government is saying that for the micro and the small, 85% guarantee cover will be given by them. For the medium category, it is for 65%. Export factoring, it means if you are exporting and you want to factor your export invoice, so in that case what you can do is you will be given the similar kind of benefit of interest subvention of 2.75% of the factoring of the interest that you have to incur. 2.75% will be given an interest benefit. Next is for the e-commerce, they are divided into two parts. First was the direct exports, the other is for the through the overseas inventory. So if you're directly exporting, then in that case 90% guarantee cover will be given by the government. If you're exporting by first keeping it in the overseas warehouse, then in that case 75%. So that is the benefit as a guarantee cover given to the e-commerce exporter. Next is the trace. Trace is basically for the certification. If you want to take a specific certificate which is only for the exporters, which is only for the export. So they have given eligible goods, they have given eligible goods as well as the eligible certificates. So 60% of the certification cost will be reimbursed by the government. First, you have to file the intent, you have to get the certificate, you have to get the audit or the compliances done, you have to get the certificate. After that, you have to apply for the reimbursement of the certification. Next is the MAS, that is the market access. Market access is basically given to not directly the exporters, but trade associations, export promotion councils, if they are basically participating in trade events. So 60 to 80% of the trade event cost will be shared by the government of India. Next is flow. Flow means if you want to have an overseas facility of warehouse, logistics service, or fulfillment center, then the government is saying 30% of the project cost will be given you as will be given to the warehousing the company who are undertaking the infrastructure. 30% of the project cost will be given to you as a reimbursement. Next is lift, a very important benefit. Lift is basically of the freight cost. Two specific condition eligibility criteria we understood. One was 200 kilometer, the 200 kilometer. That means your manufacturing premise should be at least 200 beyond 200 kilometers apart far from the port. It can be an ICD, it can be a main port. Not only main port, it can be ICD also. That is, ICD means dry ports. So dry ports or main ports, your manufacturing premise should be beyond 200 kilometers. This is the first condition. Second condition is on the eligible goods. So the goods that are being eligible, that means walnuts, makhana, pineapples. So they have defined the eligible goods. The eligible goods are around 28, which are allowed, which have been given the benefit under lift. So the benefit is 30% of the reimbursement cost. Whatever freight that you will be have to incur, 30% will be given to you as a reimbursement. Next is insight. Insight is basically capacity building, not given directly to the exporters. It is basically for the like for example education institutes, if they're planning to have a for example capacity building sessions. So in that case, the government is giving a 50% funding to to these specific education institutes if they plan to have a capacity building sessions. So this is basically the entire gambit of the export promotion mission. Apart from it, this is the last scheme that is called as a relief scheme. This is the last specific scheme. After that, I'll close the session. Relief scheme benefit is basically, ma'am also discussed a brief on this relief scheme. What exactly is the relief scheme? Relief scheme is basically because of this geopolitical situation, the major set of challenge for the exporter was on the increase in the logistic cost and also on the insurance, because everyone knows the crude oil price have increased. So your air, your freight cost have increased not only 10-15%, but has at least 50-60% has been increased. Likewise for the case of insurance, because what has happened, once you're exporting to all these Middle Eastern countries, the ECGC cover or the guarantee or the insurance, when you're taking the insurance, the insurance company is also not willing to insure your specific export, because they feel that the export order can be cancelled. There can be a war in these specific Middle Eastern countries. So there were certain set of challenges which were happening. So that is why the government came up with a relief scheme. So what exactly is the relief scheme? Under the relief scheme, they had divided into three specific parts. One is the first two part is on the ECGC cover. What it says is, once you are exporting to these specific Middle Eastern countries, once you are exporting to these Middle Eastern countries, and you are planning to take the ECGC cover. I believe ECGC cover is everyone knows that is basically credit guarantee cover. So ECGC is basically a government organization which guarantees, which give you a credit guarantee. If, for example, your export order gets cancelled, basically the buyer doesn't give you the amount of your exports, then in that case you can take the insurance of your exports. So the ECGC is basically the government organization which gives you a guarantee cover of your exports. So you have to give certain kind of premium to the ECGC, and then they give you a guarantee. So what happened, what usually happened was, the ECGC doesn't cover your entire 100% of your exports. They cover to 60 to 85% of your exports. So what the government is saying is, if your export was from 14th February to 15th of March, the entire export will be covered by the ECGC. For example, if the ECGC has given you a cover of, for example, 85%, remaining 15% will be given by cover by the government of India. So entire 100% cover, guarantee cover will be given by the ECGC. Whatever if you have already taken the ECGC benefit, because it is past, it is from 14th February to 15th of March, it is already undertaken. So between this period, if you have already undertaken exports, taken the ECGC cover, and they have given, the ECGC has given you a cover of 85%, remaining 50% the government will be giving you an additional cover. Next is basically, if you are exporting from 16th of March to 15th of June, that means 15th of June you are exporting, then also the government is saying that the export guarantee cover will be given to you. You have to take the ECGC benefit. ECGC will be giving you the original guarantee, but the government is saying will be giving you an additional support in addition to what the ECGC is given to you. But third category, for example, MSMEs are categories which they don't take the ECGC cover. They don't take the ECGC guarantee. So for them, what the government is saying, for them only the benefit is there till 14th February to 15th of March exports, that they are saying for all the additional freight and insurance which they have taken. That means, for example, when they exported, then the freight cost is, for example, 1 lakh rupees. But because of this geopolitical situation, the logistic cost increased from 1 lakh to 1 lakh 50,000. So government is saying that increase in export, that is 50,000, 50% of that will be given to you as a reimbursement. This benefit is only to the MSME. Second, the benefit is only for the exports between 14th February to 15th of March. So it is already done. It is not as on today, if you're exporting, the guarantee, the reimbursement is there, or this is a past exports. But for you as a professional, if you are exporter, have already exported within this time frame only in the Middle Eastern countries, then they can take the benefit of a reimbursement, that 50% of the additional freight as well as insurance will be given to you as a reimbursement. So with this, I think I know it was a heavy session. I've covered a lot of schemes, starting with the DGFT scheme of advanced authorization, EPCG, RoadTap, then the entire export promotion missions. So I believe I've justified the time which I've taken, approximately 1 hour. So I think, Sapna ji, now I hand over the session to you.
That was a power pack session, sir. Wholesome session, sir. Like really. Sir, there were some queries. Can we take them if ma'am is also there? So we can take a few of the queries as time permits. So we have some time, we can take them. Sir, shall I call out?
Definitely, you can call it. So
Okay, yeah. So sir, we had a question. An exporter first time exported onion to Gulf, which has been returned back to India due to Gulf War. The onion exported was perished, hence, the exporter has refused to pay the return shipping charges due. Because of that, the shipper refused to deliver the documents, the details about the goods returned back to India, that is the import manifesto, etc. Export made in March and returned in April. What course of action the exported to take in order to mitigate the consequences under GST and FEMA? Ma'am and sir, if any of you could address this query.
Ma'am, I think it belongs to you, so I think you can take it.
Yes, just please see. Uh, Once the goods have been exported, it all depends on what was the cover on those goods. See, if the good has already been exported, then the responsibility of the goods shifts. If what was the incoterms of the what you can say the export, the see what they're saying that the goods have been perished to change because of the shipper export made in March. Since the goods were already perished on their way back, it will all depends on the um, coverage, insurance coverage that was on those goods. And if there was an insurance cover, then I believe the goods can be the any reimbursements can be made on the basis of that. Otherwise, it is ultimately the shipper's responsibility for the goods. The shipper will be
I'll
responsible.
also add to it. So, under the FEMA, the real set of challenges that you have to realize within the 9 months. Here, because you're exporting and you're not realizing the specific amount, the it can be because you've exported, you have filed a shipping bill. Once you file the shipping bill, it will be mentioned in your EDPMS system. Because you're not realizing, the EDPMS will be still reflecting as a pending entry, and the bank will start insisting upon that you have not realized that amount. So in that case, because of this geopolitical situation, what you can do is, and as an exporter, you can, if you're bringing back the entire set of goods, you have to file the bill of entry again. So bill of entry, when you're filing, you have to, when as when once the bill of entry is filed, you have to take back all these set of documents that with the justification that your product was perished or basically discarded during the specific course. And bank will do is looking into your shipping bill of entry, your justification. They will be under the FEMA, they will be knocking off your entry in the ETPMS. So there will be no set of challenge from the FEMA angle. If your product is discarded, it can be discarded because of quality, perishable nature, or anything. The bank in these set of specific cases, they give a benefit to the exporters.
Okay. Uh, yes. Our next question was how to generate UIN. Please share portal details, etc.
Uh, the UDIN can be generated from the DGFT portal. Once we log into the DGFT portal, under the category or the drop down menu of the services, we'll find a specific tab for export promotion mission. So once we go under there, the different schemes will already be mentioned. For example, if it's the interest subvention scheme, we'll click into that scheme, and there you'll have to fill up an entire form. They'll ask for the details from where we can. It is an auto-generated. I mean, once you fill in the details, submit the fees, the UDIN will be automatically generated.
Okay. Thank you, ma'am. What is road tip and is it different from drawback?
So roadmap is basically, yes, totally different from drawback. Drawback is government is giving you a benefit directly into your bank account. It is not like roadmap here. Roadmap, in the case of roadmap, you have to get a script generated. In the case of due to drawback, it is directly encashed in your bank account. Another set of is the objective. Roadmap objective is all the state and central levies which the government is not reimbursing you in any specific form, like electricity duty, stamp duty, excise duties, which have not been reimbursed to you in any form. In manufacturing your export product, they are giving you a road tax benefit. But due to drawback, the benefit is on the customs. Whatever custom duty that is levied in the manufacturing process. For example, you are imported raw material, using that raw material you are exporting a specific product. So whatever custom duty that you have levied, that is being levied in your manufacturing process, that is in the form of a duty drawback which the government is giving. It is similar to road tax in the form of a percentage. In the case of road tax, it is also a percentage of the FOB value. Duty drawback is also as a percentage of the FOB value, but the percentage is different, the objective is different, and the way of giving the benefit is also different.
Wonderful clarity, sir. Uh, our next question is Our cargo was discharged at another port instead of destined port due to war. How can I claim emergency risk surcharges, demurrage, detention charges applied?
As already discussed by my co-speaker Manas sir, that under the relief scheme, this situation is very well justified there, because if the cargo was discharged at any other port, so it depends on what category do you fall into. Did you have an ECGC cover, or if you did not have the ECGC cover, and it is within the ambit of the countries where this relief scheme is benefited, if your category falls under that ambit, then you can apply for any emergency risk surcharge or any emergency surcharge on your freight cost or detention or demurrage, explaining the entire situation, giving detail of all the additional cost, all the, you have to maintain a proper document trail. You can give a detail of all the documentation, whatever extra charge was implied to you, and you can try to get the benefit through that relief scheme.
That was beautifully simplified, ma'am. Next question is, for which amount the benefit of interest is available to MSME, whether it is on the amount of duty only or on the invoice amount?
So the
Uh,
yes, you can take it now. No worries.
no, please.
So the interest is basically not on the duty or the invoice amount. It is basically the loan that you are taking. For example, you have taken a 10 lakh rupees loan. So on that, the interest that will be given, for example, it is 8% the bank is charging as an interest. So 2.75% will be an interest subvention. That is a reduction in the interest be given to you. It is not on the duty or the invoice amount. It is on the basis of the value on the loan amount which you are taking. So it can be a pre or post export loan which you are taking as a working capital loan. A 2.75% will be the interest subvention that will be given to you.
Thank you, sir. That was again a very interesting professional judgment. Yeah. Next question is road tax is refund of custom duty suffered on imports? How it is different from duty drawback?
I've already
So I
explained.
think, yeah, it is
Because
already
it is not
explained.
basically on the imports. Duty drawback is for the case of imports. Rotab is on the central and state levies, like electricity duty, stamp duty, fuels charge. So, but on the case of custom duty, it is the duty drawback which the government is giving. On the case of state and central levies, the government is giving in the form of a road tip benefit.
Yes, thank you, sir. Our next question is refund script value is equivalent to duty amount or FOB value?
So refund script value
I
is basically on the for example, you have exported 1 crore rupees of exports. So government is saying, for example, you will be given 1% of your FOB value as a benefit. So 1% of 1 crore, that is 1 lakh rupees. So 1 lakh will be given to you as a benefit. So benefit will be in the form of a scrip. So the scrip of 1 lakh rupees you can use to make the payment of basic custom duty. So once you are importing and you have to discharge and discharge while making the payment of the basic custom duty. So rather than making the payment of basic custom duty through cash, you can use that specific this script, and you can use the script to make the specific basic custom duty payment.
Okay, that was wonderful clarity, sir. Our next question was explain standard input and output norms for niche industry if not available.
So in that case,
well,
if it is if the standard input output norms are not available, then in that case, government has given a benefit of ad hoc norm fixation. You can get your norms fixed. So there is a specific committee called as norms committee in the DGFT. Once you file an application for the advance authorization, you have to specify that you have to get your norms fixed by the norms committee, that is ad hoc norms. So you will get the specific advance authorization benefit. After you get the benefit, the application is sent to the norms committee. Norms committee, they are technical members, engineers in there, where which will be deciding your case. So you have to represent the case to them. You have to mention why, how much input is required for manufacturing a single output. So even if it's a niche industry, there are specific ways through which you can still avail the benefit of advance authorization.
Okay, thank you, sir. That's a very powerful practical takeaway. Next question was export done and due to war, container is back to town. What is procedure for GST refund?
So when you've already done the export and due to this geopolitical situation, your container is back to town. When the container is back to town, if we look at the situation, it has not really been exported. So in this situation, what is the GST refund? GST refund is the amount that you've already paid at the time of your processing of the export. For example, what happens when at the time of export, we have an option of making payment of the tax at the time of export. So once we've made the payment of that tax at the time of export, once we file our return and procedures, this amount that we pay as a tax is refunded back to us as we discussed in Rule 96. So that amount is refunded to us. But in a situation when in this war situation, when the goods have not really been exported, and your shipping bill is cancelled. So in that case, your refund will definitely get stuck, and you will not be granted the refund for this situation if by the time by the time the goods are not if the shipping bill is cancelled, how are you going to file the refund for the same? So these are the situations which are definitely under the negotiation. How are they going to be done? And then you'll have to file the return explaining the situation, and it can be done through that.
Thank you, ma'am. Ma'am, our next question was, we are facing EGM details in financial year 24-25.
Well, then
So
you need
can
to
we
speak to
address
your
this?
shipping. You can speak to your shipping line for this. If you're facing issues in filing of the EGM, then it's the shipping line that you need to talk to.
Okay. And next question was, can avail export credit in addition to OD facility?
Yes, they can.
Okay. Next question was 50 lakhs with 2.75% for interest subvention. 50 lakhs is interest cost or loan amount.
50 lakhs is the interest benefit amount that a exporter can get. Whatever This is the maximum interest benefit that you'll receive on the export credit that you take.
Okay. One last question. How can we see EGM details for either bill of lading or shipping bills if forwarder not submits EGM details either in ICEGATE or NSDL? How can RoadTep license can be viewed by us and claimed by us without customs intervention?
I think unless the EGM details are filled in by your shipping line or your CHA, there are two types of EGM. One is the gateway and the port EGM. Unless the port EGM is filed, you will not be entitled to the benefit or the refund unless that port EGM is cleared. So you need to talk to your shipping line to get the EGM filed. That is the only way you can get it through.
Yes,
There is no
that's
custom.
okay. Yes. Thank you so much, ma'am. I must say the participation today had been phenomenal. The chat box was filled with highly practical and thought-provoking questions, and honestly, that itself reflects how dynamic this export practice has become today. So, with this, I just check if there is any question, or we may end this. Okay, so no questions. So, yes, today's discussion was really very interesting, a very interesting perspective every member received. As Nani Pakiwala once said, law is not a trade, not briefs, not merchandise. And therefore, understanding the spirit behind these provisions becomes equally important along with technical interpretation. So, with this, as we conclude our today's session, one thought comes to my mind. Ships are safest when they are in harbor, but ships are not built for the harbor. They are built for the sea. Similarly, businesses are not built for stable times alone, but they are built to navigate uncertainty, adapt to change, and seize opportunities. I extend my heartfelt gratitude to our distinguished speakers, CA Rachita Bhargav and CA Manas Chug, for sharing their valuable insights and practical wisdom. I am confident that the insights shared by you today will be immensely valuable for our members in enhancing their professional knowledge and enabling them to better guide businesses engaged in international trade. I would also like to express my sincere gratitude to CA Umesh Sharma, the chairman of GST and IDTC committee, and CA Rajendra P. Kumar sir, vice chairman GST and Indirect Taxes committee, for their leadership and continued support. And finally, a heartfelt thank you to all the participants who joined us today and make this webinar highly interactive and meaningful. Let us continue supporting India's exporters as they take Indian enterprise to the world. Thank you and have a wonderful day.
Thank you, everyone. Thank you so much, ma'am. Thank you.
Thank
Thank you,
you.
participants, for the patient.